All right, having a forum. Good morning, everyone. I'd like to call the June 5th, 2025 Retirement System Investment Commission meeting to order. First thing up on the agenda is to adopt this agenda. May I have a motion as presented?
So moved.
May I have a second?
So moved.
Second.
I have a motion and a second. Is there any discussion? All in favor of adopting the proposed agenda, please say aye.
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 Any opposed? We have an approval of the agenda. Thank you. Next, I hope all of you had a chance to read the meeting minutes from the April 10th, 2025 meeting. And I'd like to hear a motion for our approval of those minutes as presented.
So move.
I have a motion. May I have a second?
Second.
I have a motion and a second. Is there any discussion about the commission meeting minutes from April 10th? Hearing none, all in favor of approving the minutes, please say aye.
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 Any opposed? The ayes have it. Those minutes are approved. Next up on our agenda is the Chief Executive Officer's report. I'm going to turn it over to Mr. Hitchcock.
Mr. Chairman, the first, I guess my only item of business for my report is, and this is something that we've discussed with the commission at the previous meeting, as I'm sure all of you are aware, prior to the 2017 pension reform legislation, the commission had to approve every investment that we made regardless of the size. And in 2004, as we also know, Funds and Advisory Services has done a series of fiduciary audits on RSIC. And back in 2014, Funston recommended that the commission delegate, or that the General Assembly allow for the commission to delegate the final authority to invest to the CIO, subject to my oversight as CEO. And in the 2017 legislation, the General Assembly, pension reform legislation, the General Assembly actually acted on that recommendation and put in a provision that allowed the commission to delegate to the CIO the authority to invest up to 2% of plan assets in any one investment for liquid investments, and up to 1% of plan assets for any illiquid investment. Now, the definition of liquidity is what you expect to be able to have liquidity within 90 days or less. That's a liquid investment. An illiquid investment would be if you would expect to get liquidity in more than 90 days. The commission acted on that policy in the fall of 2017, or acted on the statute and on allowing the commission to delegate that authority in the fall of 2017, and pretty much accepted that, except it did limit, it had a couple of additional requirements and limitations. It limited reinvestments to 1%. It limited illiquid investments to 75 basis points of plan assets. This was a pretty significant departure for the commission, having been in the position to approve every single investment. So it limited as kind of a, half step or a preliminary, let's kind of see how this works and make sure that it's working properly, limited to 75 basis points, and then also put in a 5% aggregate limit on delegated investments between commission meetings. What we're asking for, well, just as we see, after doing that, the Funston came back and did another review in 2018 and lauded the fact that the commission had taken the step to delegate the final investment authority to the CIO, and determined that that is a leading practice, the way that we were able to do that. What we're asking for, though, is we're asking for the commission to increase that delegation limit for illiquid investments from the 75 basis points that it was initially put in to 1%, which would be the full amount of the limit provided by the statute that was passed in 2017. We want to do this for for several reasons. One, when we think about, the plan is growing, and when we think about core mandates in real estate, infrastructure, and private debt, having the ability to use that full 1% gives us the ability to invest more with higher conviction partners. It also allows us to really, kind of compensate for that growth in plan assets. And for these core mandates, the larger the investment we can make, then the greater the negotiating power. We believe that we have been good stewards of the 75 basis point limitation. We believe that we've acted in a way that has been very accretive to the plan value in private equity, private credit, and real estate, as well as infrastructure. So we're simply asking today to increase that from 75 basis points to the full 1% that's allowed by statute. Certainly happy to answer any question.
I wonder if Verus can tell us what is the common practice among other state pension funds with respect to limitations, if there is any.
Yeah, that I can. So first of all, maybe going back a step, I think some state retirement systems do not delegate, others do. So if we focus on those that delegate, like South Carolina does, and frankly, we think that the trend is moving in that direction. To be honest, I think it's really all over the map in terms of we have one client, for example, where it's a dollar figure, and that they have delegation authority up to $75 million commitment. Above that, it has to go back to the approval of the investment committee. But I think 1% is certainly reasonable and consistent with what we see kind of in best practices in those funds that have been delegating for the longest period of time. So we think this is perfectly in line with that.
Thank you.
So I guess really the objective, I do. I guess the objective is really to be more efficient. Is that the idea? And
that's
more
right,
effective.
Ken.
Yeah,
That's right, Ken. When we're looking at these bigger core mandates, especially like in real estate and infrastructure and private debt, it just gives us the ability to concentrate more assets with higher conviction managers. Where we, if we're doing a search and it might give us the ability to concentrate assets with 2 managers rather than 3, for instance. And it just gives us more, those bigger mandates, it gives us more negotiating power too. So it's more efficient and more effective.
Okay. Thanks.
Mike, are illiquid investments that term defined somewhere?
It is. It's defined in statute. And what I said about it's how you would expect to get liquidity. And it's also defined in the policy itself, but it's a liquidity expectation. How fast could you expect to get your money back? So if it's 90 days or less, then it's considered to be liquid. If it's more than 90 days, it's considered to be illiquid. So the General Assembly used that as the differentiator between that 2% and that 1% limit. So illiquid is 1% under statute, liquid is 2%.
So if we want to get an investment back today, even in a liquid investment, may take us 90 days to get our money back?
Well, that's how the General Assembly struck the difference between the two. I'm
right, but I mean, based on what's in the statute or the policies, that's a liquid investment.
That would be considered to be a liquid investment. That's right. Yeah. Up to 90 days, and that would maybe for some of our hedge funds that would be the differentiator between whether they're liquid or illiquid.
There's some similarity in that with the what's called cash equivalents, I think, in accounting, that's considered cash if you can get it back in 90 days.
That's right. So that was just used as the demarcation line between the two, the 90-day liquidity expectation. So.
And one more question. There's another exception that I didn't see up there, isn't there? Because we go well over 2% in our global equity investments. investments, right?
That's right.
So there must be another exception as well.
What the commission has decided is that basically the implementation of, as long as we are indexing, right, that implementation decision is not, that in and of itself is not an investment decision. That is just we're implementing the benchmark for public equity. So we have the ability to, to do that in the size and the scale that we would need to do it, right?
Well, where does the limitation come in then?
Well, the limit is the amount of, ultimately the limit is the amount of the target allocation to public equity. So, but the commission decided as long as we were, as long as we were implementing MSCI, ACWI, IMI, which is the benchmark, and we're just indexing, that's an implementation decision rather than an investment decision, because all we're doing is matching the benchmark. We are not making an investment decision at that point. Does that make sense?
The commission explicitly approved a passive menu.
That's right.
With State Street and BlackRock. Don't ask me when.
Yeah.
A long time
Well, I
ago.
remember when it was first brought up. That
Long time ago.
Yeah.
And those were
About 14,
contemplated without
14.
And if we were making a decision to make a wholesale change to a manager, I mean, that's something
Okay.
that give the commission.
Okay. So just as long as that decision's documented in minutes.
Yeah.
It might be 10 years old, but,
It's there.
that's fine.
Yeah. And ultimately the change, kind of the nuts and bolts of this, this would only, in the SIOP would only require two changes. The 75 basis point limitation appears twice in the SIOP, once in the investment policies part of the document, and then once in the delegation policy itself. So that number 75 would just change to 100 basis points.
And keeping REITs at 1%, y'all are comfortable with that?
I don't. So REITs, think of it this way. That is a REIT mandate. So we could have two REIT mandates. And it would be 2% then.
Yeah, okay.
So it's not a cap on the amount of REITs that we can
Overall.
have. And we can do REITs actively if we need to. So that is a 1% on a mandate. I don't anticipate we need more than that.
Okay.
I don't understand the phrase "to align with state law."
The statutory provision allows the commission to delegate up to 1%. And when we first initially did the policy, that was a significant change for the commission from going from, approving every investment to effectively not really approving any.
Yeah.
So that was kind of the halfway, meet us halfway point, and let's get us some proof of concept, which was at this point almost 8 years ago. So I think doesn't seem like it's been a little bit of hat. So, we're just asking to.
Yeah, so we're already aligned with state law, even if we go to 1%.
That's right. Yeah, that's right. Yeah.
Okay, that was
1%. Yeah, 1% is the maximum that's allowed under state law. That's correct.
Okay.
Yeah, that's right.
Okay.
Any more questions? Not hearing the need for any more questions, I'm going to ask Mr. Hitchcock to read the motion that's going to be put before us.
Motion to approve the recommendation of the CEO to amend the delegation policy to modify the limitation listed in section 5C4 and section 6C3 for private markets from 75 basis points to 1% of the total value of plan assets, and to authorize staff to make the technical and formatting revisions to the delegation policy and the investment policy section of the SIOP consistent with the actions taken by the commission.
May I have a motion?
So moved.
May I have a second? I have a motion and a second. Do we need to have anyone in one discussion? Hearing none. All in favor of the motion before us, please say aye.
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 All opposed? Motion passes. Thank you, everyone. Next up on the agenda is the Chief Investment Officer's report. I'm going to turn that over to Mr. Berg.
Thank you, Mr. Chairman. I am going to play hot potato and turn it over to Brian Moore, who's going to walk us through the performance through March 31st.
Thanks for that work.
Morning, thank you. Be presenting today our March 31st, 2025 performance. Kicking off with our key takeaways, we continue to see strong results. Looking back over the past 3 years, we've generated an annualized excess return of 166 basis points above our policy benchmark, which equates to roughly $2.2 billion of added value. As we transition to our new SAA on 7/1, both sides of our organization are actively involved in preparing for those changes. And lastly, we continue to remain flexible from a liquidity perspective as we navigate both the SAA transition and the evolving market dynamics that we're all very accustomed to today. Pleased to share, we've outperformed our, if we look over the excess return here, we've outperformed our policy benchmark over all trailing time periods with a current plan value of $47.2 billion. Looking specifically at the 10-year return over here, we've generated 7.02%, which has surpassed our 7% assumed rate of return. By contrast, our policy benchmark returned 6.36% over that same time period and would have fallen short of that goal. One thing I added to this, I think it would be really helpful because it actually highlights a couple different market environments on the right side of the plan growth chart. This represents the past 10 years of the plan value. So the full time series is 10 years. But if we look specifically at that tan box, which represents the 5-year time period, this actually marks the 5-year anniversary of the COVID trough post-March 2020. So we've seen a meaningful change in plan growth during that period of time where the plan itself has earned 11.65%, which is greatly higher than the 7% that we would that was assumed. The blue shaded boxes are 3-year return. And what's interesting here is we may not remember this period of time, but 3 years ago, interest rates were near zero. And over this 3-year period of time, interest rates were over 5% and have now settled around 4.25% to 4.5%. So the portfolio has experienced a wide range of market environments over this period of time, and it's been able to weather those storms as well as generate excess returns for the plan through our implementation.
Can you go back 1 second?
Yeah.
What's that number, that 5-year excess return number?
Under 268 basis.
No, the 5-year excess return in dollars, sorry.
Oh, $5,478,000,000.
That's pretty good.
That's almost $5.5 billion.
That's right.
Okay. Sorry, we
we'll do that again the next 5 years.
Yeah, guaranteed. Right.
When was the assumed rate dropped to 7%?
It went from in 2021. So and that was all built into the that expectation was built into the 2017 reform. So it went from in 2017, it went from 7.5 to 7.25, and then it went to 7 in 2020.
Okay. Just what I was thinking was, I mean, clearly we're beating our benchmark, which is critical or extremely important. But when you just look at the 10-year, total plan 7.02%, we probably didn't meet the weighted average of our assumed rate of return over the 10 years.
On a blended basis.
Yeah, on a blended basis. So, that's I don't know, not exactly sure what that indicates, but it kind of indicates it's difficult. It's been difficult to get much higher than we've been getting.
Mm-hmm. That's right.
On a long-term basis.
Mm-hmm.
Yeah, even if you look at the 10-year chart, we had periods of volatility here back in 2015 and 2016. That was driven by low oil prices in the market. That we had some credit events then. So there's been a very big dynamic of different macro events that have affected our portfolio. Yet we're still able to navigate that. And I would also say our implementation 10 years ago is not representative of our implementation today. That was another way of investing. There was a lot of legacy investments at that time. So I would say I'm happy with the 7.02%, but I think if we kind of took what we have today and put it back in the time, we'd have a much better result.
Some of the legacy, we might be able to do better now.
Oh, absolutely.
So that's weighing on that 10-year. Okay.
Yes.
Thanks. That's a good comment. Yeah.
Moving over to our asset class performance, for the quarter is relatively stable. This doesn't pick up the volatility we saw in April, but it's not going to show up in a monthly result, just given the quick recovery in April. But what I did want to highlight here is with the roll-off of that Q1 of 2020, so that represents the quarter of the first impacts of the pandemic. Our 5-year returns have undergone a very significant shift, reflecting that strong recovery. So if you look at our public equity benchmark, it's over 15%. That represents quite a recovery from the troughs of COVID post that. The other thing I want to highlight here too, before moving on, is if we think about how strong public equity did during this period of time, let's just use the benchmark of 15%. It is outperforming the private equity benchmark at that time of 10.7. This is something we don't normally see. We typically expect private equity to outperform. And on a trailing 5-year basis historically, since 1994 to 2023, this has only happened 2% of the time in any rolling 5-year period. And based on our projections, this is a one-time blip. This will correct the next time you present this. So it's just a very small moment of time.
It'll correct all the way.
All the way. Yeah.
Wow.
So it's a very small moment in time, just given that strong recovery in the second quarter after COVID.
It's like a 22% public equity return, I think, or something like that in that. So that which will roll off of the.
Yeah. So just wanted to highlight that since that's something that changed quarter over quarter.
It's almost like it's good to have a diversified portfolio, bro.
Yeah. Well, I'm getting there.
Is that something? Okay. Sorry.
We continue to see diversification. We believe it's going to yield positive results over time, but in that first box of how we think about the portfolio, diversification is weighing on this, and it's tough to outperform by having a more diversified portfolio. As I just mentioned, equities being annualizing 15% over that period of time. Most asset classes can't keep up with that. Equity is the best form of being able to get a very high result, just given what happened in the market. So the highest beta implementation we have, so equities did very well during that period of time. But as those returns more normalized, we expect diversification should become more increasingly clear as to why we have it. Despite all that, if I draw your attention to these two boxes here, the team has overcome the underperformance from the diversification side and has generated results that more than compensate the drag from diversification.
So the yellow box on the left, you just told us that the difference between public and private equity is about to disappear. Does that mean that on a 3 and 5 year basis, that around a 5 year basis, I guess not 3 year basis, but 5 year basis?
That 5 year basis, the numbers will start to improve as very strong periods of public equity performance. But it still will likely be negative, just given equities have continued to do well. They're at near all-time high. Switching over to our fiscal year to date, the impact of the 2017 legislation that Mike spoke about earlier is quite evident here in this slide. We've received $270 million of contributions into the plan, more than has been paid out as benefits. Following that, our policy benchmark has represented the bulk of the growth of the plan's assets during this period of time, and the team has added $161 million of additional value to the plan. And I'll go into a little bit more detail on attribution on the next slide. But very good financial situation we're in. What this slide represents is this is basis points at the plan level. So when you see a negative 29 here that represents negative 29 basis points at the plan level there. So we've color coded it to draw your attention to the most meaningful pieces of this. First, touching on bonds, which is that first line up there, the negative 29 basis points is primarily driven by our more defensive positioning. We've overweighted treasuries, we have slightly higher duration, and we underweight credit. The time period leading up to March, that had been a headwind. And this is an area where some of those benefits showed through in April, and so we expect this to normalize a little bit more over the course of the year. Moving down to private equity, we see 24 basis points in selection. This is driven primarily from our implementation within co-investments. I just want to share this fact. Evan's going to touch on this a little bit more, but the past 3 years, our co-investments represent 2/3 of our returns, despite only comprising 40% of our private equity portfolio. So the ability to invest with no fee, no carry is beginning to show through to these results. So, back in 2019, when we talked about how we wanted to do co-investments, really changed that. We're now seeing those results start to flow through as those investments are hitting their valuation phase. Real assets, this 59 and negative 62. This is very much requires some explanation. It's really how we proxy private infrastructure. We use a listed infrastructure benchmark to proxy that. So it creates a lot of noise, but it very much offsets. Given the benchmark change that we will have on 7/1, this will go away. So nothing to see here is the story there. And then
Famous last word.
nothing to see here yet. And then the last thing to note as we gear up for our SAA changes on 7/1, we have very little allocation effect here. So we're getting to target and we're moving towards how we implement going forward. Lastly, moving out a little bit further on the 3-year, this is a slide I'm very proud of. Actually, our policy benchmark only generated a 3.34% annualized return, whereas our team generated over 5%. Our implementation decisions effectively had a 50% improvement over the policy benchmark during this period of time. And it's not driven by any one asset class. It's driven by all asset classes. And that's something that I think really highlights how we think about the portfolio and how we want to implement the portfolio. And this slide primarily represents our investment standard deviation risk. A more real-time assessment is going to be probably next quarter as we get some market volatility from April start to show up there. And then the final thing, I'm going to hop into the appendix real fast. Before wrapping up, I did want to highlight that as has been our established practice, we want to notify you when we are outside of our ranges within the SIOP. We're currently above the 13% threshold in private equity at 13.32. As I mentioned, we're seeing good results there. So that number is going higher. And then our total private markets is roughly 31.44%, which is above the 30% threshold. On July 1st, our private equity target will shift to 12%, that 13% will look very much closer to benchmark. And our total private markets exposure will be at 40%. So both of these will be back into compliance. And so hopefully we won't have to do this for a long time after
We're not out of compliance because we have 1.44. It's a notification provision just to make sure that we're all clear. Right. And that notification provision goes to 40 in the new. That's SIOP that takes effect on July 1st. But we'll continue, obviously.
And there's nothing in there's not tomorrow overnight. This isn't going to go to like near 40% because, as we know, private markets takes time. So as we increase the level to 40%, we did get higher targets, but it takes time to build that, and we will be well within that boundary for quite some time. And then just in closing, I'm pleased with our performance both on a fiscal year and trailing time periods, and we continue to execute our playbook. So I'm happy to take any questions at this time.
I've got one. Maybe more of a comment and something for us to do in the future. everybody's probably heard or Ray Dalio and Jamie Dimon and even Elon Musk, criticizing spending and debt and all of that, and effect on the bond markets. Bond markets might have even affected some of the trade tariffs. I'm not a banker or a MBA in finance or an economist. I find it, but what they're saying, I've been worried about since I was 20 years old in the 80s, thinking I'll never get Social Security. Well, I just got my first check about 2 months ago. But this debt and spending issue is not new, and it's been I just wonder how much avoidance of it has just clouded our decisions, us globally. And if they're right, some finality comes, and and the tide turns, and people say, and it just causes some kind of chaos. I just wonder what that's going to do to all of us, all investors. So number one, I would love to get some education and get the commission some education on what all that means and how it kind of works. And Dalio apparently has 30, I think I heard him yesterday, 35 examples of things in his book. So I'll get his book and read it. But and just try to understand that, because it might affect our allocation. It might affect our performance. But I think we might be not doing our duty if we don't maybe try to understand it some more. That's my comment, and anybody else can say what they want.
No, that's a fair assessment. And I think I read this year our debt service as in the United States is going to be 18% of GDP, and it's going to exceed our defense budget. So as the national debt grows and continues to grow, it's going to have an impact on our ability to spend on other things in the United States. But it's also having, one of the things we talked about at the last meeting is we said when the equity markets were down and yet fixed income was also down, it's like, where's the capital flowing? And so capital has been flowing out of the US dollar denominated investments into Europe and other areas. And so I think that's something, I'm not saying it's a trend, I'm not saying it will continue necessarily, but I think to Jeff's earlier point, I mean, that's why we're diversified and we have investments across the globe. That I think the continued growth in the U.S. debt, it calls into question: will the U.S. dollar continue to be the reserve currency globally? Our answer is we think there'd be a lot that would have to happen for that to go away. But some of those things have already happened, and I think so. Basically, getting back to your point, I think understanding, it's impossible to predict what all of this means. And not only is the U.S. is, we have a debt issue, but they have a debt issue in Europe. They have a debt issue in China. So we're not alone in all of this. But trying to understand how this all could potentially play out is not a bad idea and not a bad educational topic for future meetings.
Let me just throw in two points from the economic perspective. Strategically, there's a real risk in the fact that a huge chunk of our treasury bonds are held by China, and they can use them to manipulate markets. And if they do, we're going to see higher interest rates. And as we know, higher interest rates are really a serious drag on economic activity. So, there's a risk out there that has been developing slowly. It's kind of like the frog in the boiling water, and at some point it can hit our assets, certainly.
Yeah.
I mean, a tangential thing going on that affects this whole situation is, our ability to get these rare earth minerals. China may not give them up.
Mm-hmm.
And what in the world's that going to do to the global semiconductor industry?
Right.
Which is to put the world in depression. And that's their bargaining chip. That's their biggest bargaining chip, I think. And why wouldn't they use it? Why wouldn't she use that?
Ukraine has them too. That's why the president's being nice to Ukraine.
Yeah.
Yeah, I think when you stand in the middle of the street and you want to look at the risk side, you also have to look at the other side as well.
Yeah.
Because, can this continue? I think a lot of people got spooked and found gold 30 years ago, and look at the returns that they've missed by focusing only on the risk side of the ledger and not the growth side of the ledger. So the challenge, I think you're absolutely right. We should very much avail ourselves of an understanding and have a discussion about these risks, but I don't want us to just sit here and look at risk.
No, I agree.
From the standpoint of, I think that sends us, that creates a temptation that we call the top to the market.
Yeah.
Many have done so, and the road is littered with their carcasses.
Yeah. So I think it'd be good. So
we need that. We can frame up a balanced conversation.
Yeah. So personally, I think I don't know enough about the risk, not being an economist or a MBA in finance.
Sure.
But yes, what's the counter to it as well? I agree with that.
Challenge accepted. We'll figure out a way, and we'll work with you guys to figure out how do we kind of figure out the right way to talk about this and what are potential investment implications. That's
okay. I appreciate that.
And there's definitely a counter to it. I mean, Bill, you pointed out yourself that you 30 years ago or 20 years ago, you thought Social Security is not going to be there.
Right.
And here we are. Because I have the same thing. I'm like, I was thinking not only is Social Security not going to be there, but I'm going to have to support at least one or two other people in retirement. So
yeah,
I think
me and
that.
Brian. I appreciate that.
Yeah.
But so I think Jeff's right. I think you have to look at it in a balanced manner, and not all debt is bad, but debt that you can't service is bad, and under normal conditions it might be perfectly fine, but we hit some kind of tipping point or some event that would cause things to turn south. So I think just being aware of what those could be and how but again, I think the answer to the question for most investors is diversification. Over the long term, diversification works. You've got exposure to long treasuries, which you've got exposure to other risk mitigating assets that should help buffer if there is a downturn. And trying to time the markets really is a fool's errand in most cases.
Good thing that we have a large liquid bonds portfolio to weather long periods of rough seas. So, we have playbooks for how do we turn volatility into an asset and drive returns. But, this is a great conversation to have. We can
go on, but so I'm sitting here thinking about
frankly.
Where does if the debt gets so big, the national debt gets so big, we say, we got treasuries. Well, they don't have the money to pay us anymore. So when do we stop hanging our hat in treasuries? The most secure thing there is, I guess.
All right.
Thank you for this discussion, though. Your thoughts?
Sure. Next up on the agenda is executive session.
We got a fiduciary attorney.
Oh, I'm sorry.
Yeah.
I'm jumping way ahead. Fiduciary training, our friends from Verus will lead us in this. Thank you.
There's no escaping. Good try. So again, I think this is something we do conduct. Is it every year? We do every 2 years. We do fiduciary training, and so this, for the most part, this will be kind of a review of what we've covered in the past. But I always think it's good to kind of hit on some of the key points, what it means to be a good fiduciary, what it means to have good governance. And I'll maybe start off by saying that, I think that your governance structure here at RSIC is among the best of certainly clients that I work with. And I'll get into why as we go through this. But what is governance? Governance is really a set of decisions that sets expectations, not just performance expectations or risk expectations, but also behavioral expectations and conduct expectations for staff and other fiduciaries. It establishes policies. We just talked through the investment policy a little bit earlier. Grants powers. We talked about delegation, and provides oversight. And really, as the commissioners, one of your primary roles, well, these are all your primary roles, but once you've delegated those decisions to staff, to the team here, your job is to provide oversight. And that's, again, a good example of what we did earlier, to talking about is 1% appropriate for illiquid investments? Is that an appropriate limit? Looking at performance, as Brian just walked through, and making sure that you understand what's driving performance and understand what's driving the risk in the portfolio is all part of good governance. But mainly to ensure that you carry out your mission. And the mission, just as a reminder, as you know, is to provide a secure future for our beneficiaries. That's the RSIC's mission. And it goes further to say beneficiaries first, their future, our mission. So really put it in, any decision that you as commissioners make, that should be kind of your first question you ask yourself, is this going to benefit, or how is this going to benefit our beneficiaries above all else? And that would cover all 5 defined benefit plans that you cover. You know them well. And it also dictates how you treat each of the plans. I mean, you invest them all holistically, but as fiduciaries, you couldn't make a decision that would benefit one plan over another plan, or that would benefit retirees over current employees. And Mike's going to talk more about that as we get into it. The governance structure itself, you have the commission, you all. Your role is to approve the investment strategy, to adopt a statement of investment operations and policies, and the annual investment plan, and then monitor the results overall. Then on the other side of the equation, PIBA is also co-fiduciary, the Public Employee Benefit Authority. Their job is to administer the retirement benefits, steward the contributions and distributions, manage the custodial relationship, and produce the financial statements for the plan. And together you kind of manage both of those key components, the investment side and the benefit side of the equation. And again, this is somewhat unique. We have a lot of our large state retirement systems where they'll have a single board that's responsible for the investments and the benefits. Again, as I said before, I think this is a good, having the investment commission set up as it is allows you to focus on the issues that really drive the investment returns, and then PIBA can focus on the issues that really drive benefit policy and contribution policy and other things. And working collectively, I think, is really it's good practice overall. As we mentioned before, I think you delegated to staff. Was that in 2017, or is that prior?
Those legislation.
Yeah, 2017 you delegated to staff the implementation decisions. And again, that's a trend that we're seeing more and more in the market among our large state retirement systems. And we do personally think it's best practices to do that. If you think about it, you think about the amount of due diligence and research that Jeff and Brian and their team do on every investment that they make, but especially the private investments or the alternative investments, and to have that level of expertise and the ability to be nimble and implement quickly is really important. And so, you know, I'll just contrast it. I have one client where the board gets close to 1,000 pages every meeting. And, you know, to think that they're going to be able to go through that and make a qualitative judgment on an investment manager, I think that it's very difficult. So I think, so again, I think having delegated that, you have a duty to monitor, as you well know, and you do that on a regular basis. But the implementation with staff is probably it is best practices in the industry today. And then finally, the investment consultant, we report to the commission. So we are here, we work closely with Mike and Jeff and team, but we're also, you know, we report directly to the commissioners to make sure that, you know, you're fulfilling your fiduciary duty and that staff's fulfilling their fiduciary duty, and that we also do that. One thing I should note about fiduciary duty, and we can do that on the next page, you know, fiduciary is a person who's legally and ethically obligated to act in the best interest of another party. In your case, it's the beneficiaries of the retirement systems. And you're required to make decisions with care, diligence, and integrity. And one thing I would note, and back in the day, you had people in our industry, there were competitors of ours, you know, 20 years ago or so, that tried to contractually absolve themselves from being a fiduciary, declare that they're not a fiduciary. That doesn't work. The nature of your role makes you a fiduciary. The nature of our role makes us a fiduciary. Mike, Jeff, Brian, team, everybody who works in the retirement system investments is a fiduciary to the beneficiaries of the plan. The other key thing about being a fiduciary, and you've heard this before, it's not about results. You know, mistakes will be made. There will be investments that underperform, and there might be times where the system overall underperforms its policy benchmark. As fiduciaries, you're not necessarily accountable for those results. You're accountable for adhering to a disciplined process and documenting that process. And so it's really about that. And again, what we've seen here in the time that we've been working with you, we think has been excellent in terms of, you know, the information that you digest as commissioners and that you're presented as commissioners, the documentation that goes into that, and then the decision-making process. And again, that's really the key to fulfilling your fiduciary obligation. So you know this already. I'm not going to spend a lot of time on it, but you know, as commissioners, you're the ultimate fiduciary. You define the enterprise objectives. So, and that really kind of starts with your reference portfolio, which kind of drives the amount of volatility, the risk that you're willing to accept in the portfolio. And if you recall, that we did the exercise a while back in advance of the asset liability study, but we interviewed the commissioners to determine the enterprise risk tolerance, like not only how much volatility you're willing to accept, but what type of asset classes you're comfortable with, what kind of downside risk are you willing to accept, what kind of illiquidity risk, other things. And I think that's an important exercise because understanding the enterprise objectives overall and defining those is really your primary role as commissioners. Develop and monitor the investment policy. Again, that's something you do on an annual basis. You know, relying on advice from subject matter experts, not just us, but groups like Funston. You have specialty consultants as well that you utilize, actuaries. As commissioners, it's fully within your rights to rely on subject matter experts. And then delegating the investment or the direct investment approval to the CIO under the CEO's review. The staff's role and as fiduciaries help commissioners define these objectives, develop the investment strategy, investment policy. Their role is to source investment ideas conduct the due diligence, as we talked about. They're going through and doing site visits and doing operational and investment due diligence on these firms. And then they also monitor and manage the results. And then ultimately, they're the implementers as well. And then you could also, the investment managers that you hire to run the public markets investments and others, they're fiduciaries as well. And am I turning it over to you, Mike?
All right, thank you, Mark. Yep. So in the next couple slides, we're going to outline a few standards for discharging your duties as commissioners that are outlined in the RSIC governance policy manual. So these are things obviously that you can access and go over, but we think it's an important part to review as part of this fiduciary training. So if you look at here, this page shows the standards for discharging your duties as commissioners. And I'm not going to go through the list point by point, but I did want to highlight just a few things. So if you look at the first two, so as you discharge your duties, they are to be done solely in the interest of retirement system participants and beneficiaries for the exclusive purpose of providing benefits to your participants and beneficiaries. So at the end of the day, when you're making decisions, that's your end goal and objective, is to make sure you're doing things in the best interest of the participants in the plan and not doing so for other considerations, whether they be political, thematic, other kind of objectives like ESG. At the end of the day, you're always, when you're making decisions, you're thinking about the beneficiaries in the plan. That's who you're making decisions for. If you look at the third bullet, so when you're, whatever action and decisions you're making, you're doing so with the care skill that a prudent person would like in a how they would act in a similar capacity. And so as a fiduciary for the plan, there is the standard of prudence. So it's assumed that the decisions you're making would be a prudent person in a similar capacity would be making similar type of decisions. And then the fifth bullet down, you can see incurring costs that are appropriate and reasonable. So that's not to say you always have to do things at the lowest cost level, but make sure that whatever costs you're paying for various services, whether it be investment management, investment consulting, actuarial, et cetera, that they are reasonable, appropriate for the level of services that you're getting. On the next,
I'm sorry, Mike, I just wanted to interject. So most of the fiduciary lawsuits that we've seen over the past 5 years have related to failure to manage costs, number one, and monitor costs. And then two, and this might actually go back a little bit further, but you saw some of your state retirement system peers where they would invest in private markets investments that were introduced via a placement agent. And that placement agent would get paid based on the commitment that was made. And in some cases, that placement agent was a relative or a friend of a board member. And so that just obviously if that's not for the exclusive benefit of the beneficiary. So that's an obvious example. But again, if you always place kind of the first question you ask yourself is, does this directly benefit the beneficiaries of the plan? I think that's going to keep you on the straight and narrow.
So on the next slide here, we look at the responsibilities for individual commission members that's outlined in the governance policy manual. And again, I don't want to touch upon every bullet point, but just to highlight a few. So, at this starting point, it's important that commissioners are informed about the RSIC's missions and policies, and also any kind of state law that governs the commission and the fund. Attend meetings when able to, and if not, obviously notify the CEO and chair as soon as possible. Review materials, including agendas, any kind of educational materials that are provided to you in advance of the meeting, so that you're able to make really kind of discussions more meaningful and be able to ask good questions that will allow you to be informed on the various aspects of the fund. Council will work with CEO and other fiduciaries who help you in regards to managing the plans, such as investment consultants, actuaries, and things of that nature. And at all times, act with high ethical standards and always try to avoid even an appearance of impropriety. Next thing I want to talk about is pecuniary factors. So this is something that has percolated up over the past few years, and certainly you probably heard a lot about this in the industry news, and it's something that we've talked about here within the commission over the last few years. So just by a starting point, the pecuniary factor that's identified as anything that would have a material effect on the risk or return of an investment based on appropriate investment horizons consistent with the plan's investment objectives and funding policies. What we've talked about this in the past, but it's outlined in the SIOP that the commission will only consider pecuniary factors when making decisions for the plan overall, or allocating capital to an investment manager. So non-pecuniary factors would be considerations outside of anything that might affect the risk return of an investment. That might be such things as considering political goals, other objectives. The one that's kind of most notable that we've talked about in the past and other plans, public plans like ourselves just talked about in the plan, are ESG considerations and how ESG considerations should be thought of in terms of investment decisions. So one of the things that's been outlined for RSIC is that any kind of decisions in regards to investments made for the program must consider only these pecuniary factors and not anything outside of that. And if you look at the last bullet, one of the things that Mike as CEO has to do is any kind of documentation for any investment that's made. He has to certify that decisions that were made for that investment were based on pecuniary factors. So last thing, so here we just assembled a list of best practices for fiduciaries, and these are takeaways that we've assembled from working with plans like yourselves over a number of years, and really what we find to be kind of the actions and tactics that are best practices to lead the best outcomes. And so, again, I'm not going to go through this entire list, but, it's important that you know and understand specific standards laws that apply to this organization and the fund. Diversify your investment portfolio. We talked about this earlier today. The best way to really protect yourselves from some of these, large market events that might have negative implications on return of the portfolio is through diversification and having exposure across many different asset classes, which over time we think is the best way to manage risk. Review and approve the SIOP and make sure that the plan is operating in accordance to the policy document, the SIOP. And I think we do that quite regularly here within the RSIC. Down at the bottom, avoid conflicts of interest and prohibited transactions. So again, just manage make decisions and manage the program in a way that is kind of adhering to ethical standards and doing things for your beneficiaries and not for other interests. And then finally, and at the bottom, I think this is probably the most important bullet of the whole thing: ask questions. And I think Bill, your question earlier today, having questions like that, and which leads to good dialogues and having more broad considerations about things like risk and what potentially happen in the economic environment if certain economic forces move against us. Having those kind of discussions are important, And the only way we get there is from folks like you asking questions. So I think a lot of times what happens is when you get in settings like this, folks can be afraid to ask questions because they think maybe that's not a good question, or maybe that I'm the only one with that question. But I think a lot of times other folks might have a very similar question as you. They just don't want to ask the question. So if the more open folks are and the more questions that are asked, I think that leads to better outcomes in the long term. So that concludes our formal remarks. Is there any questions that we can answer?
Anything for our friends from Verus? Hearing none, we'll move on to the next item, which is a delegated investment report.
And what will go down as the fastest delegated investment report ever. We did not execute any new investments since the prior meeting.
Come on.
So, oh, they're coming. Oh, they're coming. Follow this up with the longest delegated investment report.
Very well.
Things are getting done.
All right. So as I mentioned in error earlier, I think I'm correctly mentioning now that it's time for us to proceed into executive session. I'll ask our CEO to read the motion for that.
Thank you, Mr. Chairman. Motion to proceed into executive session to discuss investment matters, including specific co-investments and private equity investments, and certain portions of the consolidated annual investment plan and statement of investment objectives and policies pursuant to SC Code Sections 9-16-80 and 9-16320, to discuss personnel matters and to receive advice from esteemed legal counsel pursuant to SC Code annotated Section 30-4-70 A1 through 2.
May I have a motion?
So moved.
May I have a second?
Yep.
All right, I have a motion and a second. Is there any discussion? All right, all in favor of proceeding into executive session, please say so by saying aye.
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 Are there any opposed? The ayes have it. We're now in executive session. Let's do those anymore. I think the last thing we need to do is adjourn. So I'll call for a motion to adjourn, please.
So moved.
Second.
I have a motion and I have a second. All in favor of adjournment, please say aye.
Aye.
The ayes have it. We stand adjourned. Thank you all.
Take care, everybody.
Thank you.